Hello guys, in this video we will talk about bond. What is a bond? A bond is a fixed income instrument that represents a loan made by an investor to a borrower, typically corporate or governmental. A bond could be thought of as an IOU between the lender and borrower that includes the details of the loan and its payments. Bonds are used by companies, municipalities, states, and sovereign governments to finance projects and operations. Owners of bonds are debt holders or creditors of the issuer. Bond details include the end date when the principal of the loan is due to be paid to the bond owner, and usually include the terms for variable or fixed interest payments made by the borrower. Key takeaways. Bonds are units of corporate debt issued by companies and securitized as tradable assets. Bond is referred to as a fixed income instrument since bonds traditionally paid a fixed interest rate to debt holders. Variable or floating interest rates are also now quite common. Bond prices are inversely correlated with interest rates. When rates go up, bond prices fall, and vice versa. Bonds have maturity dates at which point the principal amount must be paid back in full or risk default. The issuers of bonds. Governments and corporations commonly use bonds in order to borrow money. Governments need to fund roads, schools, dams, or other infrastructure. The sudden expense of war may also demand the need to raise funds. Similarly, corporations will often borrow to grow their business, to buy property and equipment, to undertake profitable projects, for research and development, or to hire employees. The problem that large organizations run into is that they typically need far more money than the average bank can provide. Bonds provide a solution by allowing many individual investors to assume the role of the lender. Indeed, public debt markets let thousands of investors each lend a portion of the capital needed. Moreover, markets allow lenders to sell their bonds to other investors or to buy bonds from other individuals long after the original issuing organization raised capital. How bonds work. Bonds are commonly referred to as fixed income securities and are one of the main asset classes that individual investors are usually familiar with, along with stocks, equities, and cash equivalents. Many corporate and government bonds are publicly traded. Others are traded only over the counter or privately between the borrower and lender. When companies or other entities need to raise money to finance new projects, maintain ongoing operations, or refinance existing debts, they may issue bonds directly to investors. The borrower issues a bond that includes the terms of the loan, interest payments that will be made, and the time at which the loaned funds must be paid back. The interest payment is part of the return that bondholders earn for loaning their funds to the issuer. The interest rate that determines the payment is called the coupon rate. The initial price of most bonds is typically set at par or $1,000, face value per individual bond. The actual market price of a bond depends on a number of factors: the credit quality of the issuer, the length of time until expiration, and the coupon rate compared to the general interest rate environment at the time. The face value of the bond is what will be paid back to the borrower once the bond matures. Most bonds can be sold by the initial bondholder to other investors after they have been issued. In other words, a bond investor does not have to hold a bond all the way through to its maturity date. It is also common for bonds to be repurchased by the borrower if interest rates decline or if the borrower's credit has improved and it can issue new bonds at a lower cost. Characteristics of bonds. Most bonds share some common basic characteristic including face value. Is the money amount the bond will be worth at maturity? It is also the reference amount the bond issuer uses when calculating interest payments. For example, say an investor purchases a bond at a premium of $1,090 and another investor buys the same bond later when it is trading at a discount for $980. When the bond matures, both investors will receive the $1,000 face value of the bond. The coupon rate is the rate of interest the bond issuer will pay on the face value of the bond, expressed as a percentage. For example, a 5% coupon rate means that bondholders will receive 5% x $1,000 face value, 50 every year. Coupon dates are the dates on which the bond issuer will make interest payments. Payments can be made in any interval, but the standard is semi-annual payments. The maturity date is the date on which the bond will mature and the bond issuer will pay the bondholder. The face value of the bond. The issue price is the price at which the bond issuer originally sells the bonds. Two features of a bond, credit quality and time to maturity, are the principal determinants of a bond's coupon rate. If the issuer has a poor credit rating, the risk of default is greater, and these bonds pay more interest. Bonds that have a very long maturity date also usually pay a higher interest rate. This higher compensation is because the bondholder is most exposed to interest rate and inflation risks for an extended period. Credit ratings for a company and its bonds are generated by credit rating agencies like Standard & Poor's, Moody's, and Fitch Ratings. The very highest quality bonds are called investment grade and include debt issued by the US government and very stable companies like many utilities. Bonds that are not considered investment grade but are not in default are called high yield or junk bonds. These bonds have a higher risk of default in the future and investors demand a higher coupon payment to compensate them for that risk. So guys, we will end this video. Goodbye.